I wanted to start off with the economy, and it's all over the corporate media. People are talking about the economy. We see what's happening in retail, and it's a complete disaster right now. And you wrote a lot of articles about retail and how it's doing, and we see a lot of stores closing. And I wanted to get your take and what you think is happening in retail and where you think it is headed and how it affects the economy.
I call it the brick and mortar retail meltdown. And that's really what it is. I'm not exaggerating. Brick and mortar retail is melting down, has been melting down for like 2 years. And in the overall retail numbers that we get, this doesn't really show up that much because online retail is strong. So online retail has been growing. E-commerce has been growing at a rate of about 15% a year. And that's been pretty stable from around 14.5 to, close to 16% every year. So it's booming. The big gorilla there is Amazon, but there's a lot of other companies, even brick and mortar companies like Macy's and Walmart. They're trying to carve out a big presence online because that's the only way they're going to survive. So in brick and mortar retail, we had another bankruptcy today. Sears of Canada threw in the towel, sought bankruptcy protection this morning. Sears Holding in the United States still owns a part of that. And Eddie Lambert, the CEO of Sears Holding, owns, and his hedge fund own about 45% of Sears of Canada. That's just one more step. Target in Canada also went bankrupt in 2015. Sears Canada is trying to avoid liquidation. Right now, it's trying to restructure, but retailers are notoriously difficult to restructure. All the good assets, the real estate they had, which Sears Canada had quite a bit of real estate, sold off to survive. They borrow money to survive, and at some point when they can't borrow any more money because they're bleeding so much cash and the lenders are pulling back, that's when they go bankrupt. And there's nothing left really anymore. There's the assets just don't cover the debts, and the stockholders get wiped out, and some of the junior creditors will get wiped out, and some of the other creditors will get big haircuts, and in the end, usually retailers get liquidated. And this has been going on in the United States. We have seen numerous retailers in the United States, brick and mortar retailers, go bankrupt this year. A whole bunch of them, last year, the store closings, even retailers that are in decent shape, like Macy's, have been closing hundreds of stores. The mall REITs have gotten completely crushed. The publicly traded mall REITs, the biggest one in the United States, their shares are down 40, 50, 30% in that range, from a year ago. So the brick and mortar end of retail is in just full-fledged meltdown mode right now, every part of it. And everybody's struggling to get online, and if they can't get online enough, if they don't get enough momentum online, they're looking at their end. And Sears Holdings in the United States, earlier last year in December, I postulated that will go bankrupt in the second half this year, no sooner than the second half this year, because in July sometime, 2 years ago, they sold some properties to a related party for several $1 billion, and they would have to wait 2 years for the fraudulent conveyance provisions of the bankruptcy code to dodge those provisions, and those 2 years are up in July. So the fraudulent conveyance provisions would allow creditors a clawback. And so Sears Holdings will go bankrupt. It's just a question of when. And my guess a year ago was that they would do that no sooner than the second half this year. Sears Canada already did. So, those are the big ones, and the retailers that have gone bankrupt so far were smaller ones, like Payless Shoes. They're pretty big. They have thousands of stores, Radio Shack and those ones, but they're not the huge department store retailers that are now getting closer.
So when we see all these stores closing, of course, the strip malls, the malls are all hit. What happens to all this real estate that the retailers, have acquired over time? Now it just sits empty. What happens to that?
Well, a lot of that real estate, Sears already sold a lot of its real estate, including like the Art Deco building in Oakland, in downtown Oakland, that Uber bought. and is trying to, or was trying to move its headquarters into, and that is now, of course, falling apart as Uber is melting down. So, I mean, I don't know what they're going to do with that building, but some of the nicer, older retail buildings that Sears had are, they're being repurposed into office buildings. Some of the like Sears sold its the Macy's sold its men's store in San Francisco. That was right downtown in the Union Square area. That's a very expensive piece of property, and that's going to be repurposed into something else. Some developer bought it, and they're going to redo that. So that has a lot of value. But a lot of the malls in the outlying area, I mean, they're turning them into parking lots for the car industry that's not doing well right now, and that has all this overflowing inventory. So they're parking new cars on them. Some of them are trying to turn them into big restaurant places, but chain restaurants are not doing well either. So homes for or retirees. And I mean, all kinds of plans are being hitched to repurpose these malls, but it's really hard. I mean, in the end, a mall owner wants to profit from the rents it's getting from the retail industry. Once the retailers leave, there's no more income. Then it's just the land. A lot of times the mall will have to be torn down, and a developer will come and build something new. So the land may be valuable, and they're going to put apartments on it or something. But the people who own the mall, they'll just end up with the value of the land and nothing more. I mean, the income stream is gone, and the value of the business is gone. So it's really tough out there right now in the mall space, and that's why the mall REITs have really gotten crushed. I mean, they even the biggest and the best ones have taken a huge licking in the stock market. As a year ago, the stock investors finally caught on to what is happening in that space.
Now, I wanted to switch to housing, real estate, and the corporate media. They are continually telling us that the housing market is doing fine. Prices keep going up. When you look at the housing market, does this look like another bubble to you, or are you looking at it saying, okay, the housing market is perfectly fine, there's nothing wrong with it?
Neil Kashkari, the president of the Minneapolis Fed, wrote an essay a few weeks ago, essentially stating what Ben Bernanke had stated before, that the Fed cannot see bubbles, and even if it could see bubbles, it couldn't do anything about them because it doesn't have the tools to do anything about bubbles. And even though it has the tools to create bubbles, it doesn't have the tools to do anything about bubbles. And I wrote an essay back essentially saying to Mr. Kashkari, look, those bubbles in the housing market are really easy to see. And I added a bunch of charts of the different housing bubbles in the United States. So in some of the major cities like San Francisco, Boston, New York, a lot of these cities had huge housing bubbles where home prices are now substantially higher than they were at the peak of the crazy bubble that blew up in 2006 and 2007. And even adjusted for inflation, we have now in those cities exceeded the prior bubble peaks. So for the Fed to go out there, or for Kashkari to go out there and say we can't see those bubbles, that's just nuts. And actually, I think it's just propaganda. The other Fed members have been quiet about that. Actually, they've been addressing the bubbles, and in several Fed missives, they have specifically addressed some of the housing markets like San Francisco, the commercial real estate bubble all around the country. And I think that's one of the reasons they're tightening. They're seeing the bubbles. And the bubbles are huge. They've been there for years. They're getting bigger and bigger. San Francisco, which is probably the craziest housing bubble in the United States right now, it started flatline a couple of years ago, and it just sort of went up and down a little bit with a slight downward trend in condos and house prices. And then in May, the median price suddenly shoots up again, and in some extraordinary manner. And I'm still waiting for the June and July data to come out to see whether that was a blip or whether that's a resurgent housing bubble here. But the prices are just nuts in San Francisco. I mean, you're looking at a basic median condo selling for, $1.1 million, and these are small places. There's nothing fancy about them. So, the bubbles are just huge. In some cities, until recently in San Francisco, it flatlined. In Miami, the condo bubble has hit hard times. There's big issues in the New York City real estate market right now. So in some of the big cities, the housing market is starting to create a little bit. We have seen apartment rents come down in some of the major markets and the most expensive markets. And in San Francisco, they're already down. The median asking rent is down between 10 to 15%. And that has an impact on the other aspect of housing, which is commercial real estate and apartments. Now, these are big towers, they're being built in massive numbers. New supplies coming on the market. San Francisco is no longer creating the jobs that it used to, and it's creating downward pressure both on condo prices and on rents. And on condo prices, again, in May we had this big spike, but we'll have to see whether that was just a blip or not. At any rate, I think the bubbles have reached, in some cities, the bubbles have reached an extraordinary level. In other cities, it's been subdued. So real estate is very local. On a national basis, we're back where we were at the peak of the prior bubble in terms of home prices, but that kind of covers up the drama in on the ground, where you have some cities just soaring and with their home prices, and in other cities it's sort of muddling along. And so on a national basis, I think we're in a bubble. On a local basis, in some of these cities, we're in an extraordinary bubble, and that cannot be maintained. It's just not possible. And once you reach these levels, there's no plateau. There's no way to plateau there. Once demand craters for these expensive homes, that it will turn into a bust. And we've seen that every time, and we expect it this time around too.
Do you think that when this housing bubble market implodes, do you think it's going to be what we saw back in 2008, or do you think it's not going to be as bad, or do you think it's going to be worse?
I do believe that the banks are in better shape than they were back then in terms of the ability to withstand a shock. Fannie Mae and Freddie Mac are now fully guaranteed by the government. Back then, and they guarantee the mortgages that they package into mortgage-backed securities. During the last crisis, there was only an implicit guarantee, and they ended up getting bailed out. The guarantee was not explicit. Now the guarantee is explicit, and they're actually owned mostly by the government, and so that's changed. On the other hand, the values are much higher. So if the San Francisco bubble bursts, for example, we've now reached home prices that are 50% higher than they were at the peak of the prior bubble. So the dollar amounts involved in terms of the mortgages are much higher. And so when the collateral value drops, percentage-wise maybe in the same range, but in terms of sheer dollars, the magnitude of the dollar amounts are just different now. And that happens in other cities too that have exceeded the prior bubbles. So in those areas, I think the dollar damage will be larger. The percentage damage may be the same. I don't exactly expect a nationwide bust. I expect some cities to come down pretty hard, and other cities to continue to rise. And so on the nationwide numbers that the Fed is looking at, it might not show up as much. It might show up as a plateauing or flattening out, when in fact you have bubbles locally collapsing, and then it can cascade through the economy that way, and it may never really bring the national numbers to a collapse, as each time a city collapses, other cities go up, it just cascades through, and then over the many years. So, and then it's kind of my hope, because when if we have another nationwide housing bust like we had, the Fed's just going to jump in and do the same thing it did back then. And that's the one thing to avoid. You want to keep the Fed out of this, and you let this market correct on its own. And if it corrects on its own, city by city, one after the other, and banks being being nationwide, and they'll take a loss here and then take a loss there, and they'll make more money over this way, and they can avoid a bailout. They won't do well, but they can avoid a mass bailout like we went through last time. So that's kind of my hope. I mean, that's like the best case scenario that I can envision, is that it only happens step by step in a cascade, that it spreads over the years, and that it's not just one sudden liquidity event that we went through during the financial crisis.
So, I mean, right now we see retail taking a hit. You mentioned auto manufacturing not doing well. We have this housing crisis, and the Fed, they're raising interest rates during this period of time. And when you look at this and you research this, is this a good time for the Fed to start raising the rates?
Yeah, I'm a big proponent of higher interest rates, and I, for years I've been saying the Fed should have never done QE. This country needs a shakeout. The debt needs to blow up. It needs to go away. There's too much debt. The only way this debt can blow up if the Fed stops supporting it. And I mean, if it keeps printing money and having zero interest rate policies out there, everybody can refinance, and and companies don't go bankrupt. And when they don't go bankrupt, they don't get rid of the debts, and and consumers the same way, and so they cannot shed these debts that are now encumbering them. And so I think we need to go through a cleansing period. These bubbles need to be unwound, and the debt that's associated with these bubbles needs to go away. And the way that happens is through different forms of bankruptcy. And the only way this is allowed to happen is if we have higher interest rates, and if the Fed steps away from subsidizing and supporting long-term interest rates. So right now it's raising short-term rates. It's just very carefully, very slowly, in baby steps. It's raised them 1 percentage point so far in this cycle, from next to zero to just a little bit above 1%. Long-term rates have come down. This is part of the flattening yield curve problem. So now the Fed is planning to unload part of its balance sheet. So it will not refinance some of the securities that are maturing, and this can take. So they will start pretty soon, and there's a phase-in period, and after that phase-in period, 12 months after it, they'll get rid of like $600 billion a year in these securities. That's a lot, and that will bring up long-term rates. So you will have, and that hasn't set in yet, and the market has brushed this off. I've been writing about this, so that's going to be an adjustment coming, and that adjustment is going to be painful in the markets. But the long-term yields will go up when the Fed starts unloading its balance sheet, and mortgage rates will go up. And so these expensive homes that people are trying to sell now, the buyers would have to finance them with mortgages that have much higher rates, and that won't work. So you'll have tremendous pressure on home prices coming from that direction, especially in the most inflated markets like San Francisco. In markets that are cheaper, it's not that big of an issue. But in the really expensive markets, that's a big issue. So I think the bubbles will burst first. And the Fed has its eye on these bubbles, and they want to tamp down on them before they get so big that they're going to take down the global economy when they burst. And so I think they're really focused on these bubbles now. And despite of what Kashkari is saying, the rest of the Fed is focused on these bubbles, and they're trying to do something about them. And so I think, I'm very supportive of the Fed rate hikes. I was opposed to the zero interest rate policies. I was opposed to QE in general. I was okay with the Fed acting as lender of last resort during the bailouts, during the financial crisis. But QE was never a lender of last resort. That was a different program. That was designed to inflate asset prices, and I was opposed to that. We needed to let this thing wash out. And so now, yes, I'm very much in favor of the Fed raising rates. I'm very much in favor of bankruptcies taking care of the debt that's out there, and with creditors taking the losses. That should have happened during the financial crisis, and it wasn't really allowed to happen. And I expect it to happen this time around, and I'm kind of hoping that the Fed will allow it so that we get that cleansing that we really needed more than anything. And hopefully it'll come slowly, not only one day. If this whole thing seizes up and comes in one day, as it did during the financial crisis, everything comes to a halt, and that can be catastrophic. My hope is that this will set in gradually, that rates will go up on the short end, that they will go up on the long end, that companies will be forced to restructure their debts and will shed their debts, and that we can move forward in better shape.
From what I'm hearing you say is that the Fed is doing this, and hopefully things come down. We have like some type of reset that we should have had back in 2008. And I just wanted to get your take on this and what you think. Now, the Fed is unwinding their Fed balance sheet right now, where we're at the height of the bubbles. So they have a lot of toxic real estate and things like that, and they're going to start getting rid of it. Do you think that they're getting rid of a lot of this on their balance sheet because they know there is going to be another recession and they're just trying to clean it out before that hits?
I am sure that is one of the big considerations. Everybody knows that sooner or later there will be a recession, simply because there are business cycles and they still exist. And so, every time there are excesses, there has to be a cleansing period afterward, and that cleansing period is a recession. And so they know that. Everybody knows we're going to get a recession someday, and whether that's this year or next year or 3 years from now, we don't know. But that recession is going to come. And the Fed has already promised that if credit freezes up again, like it did during the financial crisis, it will use QE again or similar balance sheet measures to step into the markets. They would like to do that from a point of strength, where the balance sheet has already been reduced and where interest rates are already higher, so they can actually cut them. They've watched negative interest rates in Europe and in Switzerland and Europe all around, not just in the Eurozone, but in Switzerland and other countries. And they've watched it in Japan, and they don't like what negative interest rates are doing. And I think they're trying to stay away from them. And so they need to raise rates to have room to cut, and they need to get rid of some of their balance sheet assets to have some room to step in. I think that's a clear part of their consideration right now. But I think the dominant consideration right now is the asset bubbles that are just getting out of hand, and they've been specifically mentioned. So they've shown up in writing in the statements. So that is really something the Fed normally doesn't do, and they've been preparing the markets for this. They've been saying, look, we've got some asset bubbles and we need to take care of them. So I think that's the primary consideration, and having some dry powder when the next recession hits, I think that is also a big consideration.
Now, you mentioned the credit markets, and we see that the credit impulse, it turned negative. And a lot of people saying, well, since this turned negative, and China was really one of the countries that was pushing the credit during the last 2008 moving forward, it looks like that is dying off right now. When you look at the credit impulse, what do you see happening with this, and what does this tell you?
It tells me several things. One is that there's a huge amount of debt already out there, and it is increasingly difficult to add to it for various reasons. And you look at over-indebted households in a number of countries, particularly in places like Canada and Australia. You look at over-indebted governments such as Japan and the United States. You look at a debt situation like in China that is completely out of control now. And it's getting very difficult to add to it. The credit impulse measures the flow of new credit. So adding new credit is a positive, and when new credit declines, it's a negative, and it's measured against GDP. So it's a global measure, and we've seen credit sort of get in trouble in some places. And in the United States too, commercial and industrial loans have been essentially flatlining for half a year. That has never happened unless there's a recession nearby. Commercial and industrial loans are used not to buy back shares, but they're used by companies to actually expand their operations. So to buy equipment, to build a plant, It's used by small companies. It's used by large companies. So these are actually these are monies that are borrowed to engage in productive activities, and that's not happening anymore. So that's flatlining. We have seen some consumers cutting back. There's a real weakness in that, and that's the thing. It tells me, that there's a little bit less borrowing going on to get money that will be spent or invested. And GDP counts investment and it counts spending. So, eventually when less money gets borrowed to invest and spend, you'll see that enter the equation in GDP, and the economy might take a downturn. So far, it has, the credit impulse has declined, is slightly negative. It's not been negative for very long. So we'll have to see. If that drags on for a long time, that will be a definite recession warning on a global scale.
So we are seeing different recession warnings. Just a little bit back when we were talking about what is happening in the economy and with the Fed, you mentioned the inverted yield curve or the flattening yield curve. And again, this is another sign of a recession. Now, when you look at this and we're seeing a flattening or approaching an inverted yield curve, where does this take us? What do you see happening in the economy while this is happening?
Yeah, so that is actually not an uncommon thing to happen when the Fed tightens. These flattening yield curves happen when the Fed raises interest rates at the very short end. So the Fed has a target range for the federal funds rate, which is essentially an overnight rate, and then that impacts the market. So at the short end of the spectrum, so the 1 month, the 3 month rates, the 6 month rates, they're all going up when the Fed raises interest rates. In terms of, and let's talk a little bit about the era that we no longer have before central banks got involved in QE. So when central banks weren't involved in bond buying programs, what would happen is that the short end of the curve would come up, and the market would be concerned that funding would get more difficult, that interest rates are going up, and that therefore there might be a recession down the road. And in order to prepare for a recession, the market would start selling stocks more intensively and start buying treasuries, long-term treasuries, with great enthusiasm, and that brings down the long-term treasury rates. And so you have them go up on one end and going down on the other hand, and so it flattens and sometimes it inverts where, the short rate may be, as it was at one of the last times, it may be 5%. When the Fed really gets serious at the short end, and the 10-year Treasury may be below 5%. What we have now is that globally, central banks are buying bonds, and they're still buying in Europe. They're still buying in Japan, and it pushes investors out of it replaces investors in the bond market. So that goes somewhere else. And they see the yields in the United States. So you have a lot of international investors plowing into U.S. Treasuries, buying them. And this buying pressure pushes down the long-term rates in the United States. So given that we have these manipulated bond markets, I don't know, which we didn't have to that extent the last time we had a flat or inverted yield curve. Given that we have these central banks playing in the bond market so intensively, I don't know that the yield curve tells us what it used to tell us. And it used to tell us there's a recession coming. I don't know if that's still the message. The message is that QE is going on in other parts of the world, and we have these NERP refugees, as I call them, the negative interest rate policy refugees from Europe and from Japan, piling into U.S. Treasuries to survive. And so they're pushing down the yields. Now, the Fed is doing the opposite now. They're trying to shed some of the long-term assets on its balance sheet that will counteract that. So that will eventually start putting upward pressure on yields. And I think that's another reason, a third and maybe less important reason for the Fed. They want to avoid for the yield curve to flatten further, because that's a problem for the banks. Flat yield curve or inverted yield curve is a real problem for the banks. And it can actually cause a recession rather than being a sign of a recession. I mean, that's the other relationship with what the cause and effect. Does it cause a recession, or is it just a predictor for recession? And so the Fed wants to avoid an inverted yield curve. So that's that's why they're unanimous in the decision to unload the balance sheet. Because that will eventually bring up the long-term rates. So again, they're manipulating the market, and we don't really know what the market would do without all this central bank interference. But I know the Fed is very, very concerned about a flat or inverted yield curve, simply because of what damage it can do to the economy when long-term borrowing gets so cheap the banks don't lend anymore. The credit dries up, because now the banks have no incentive to make 10-year, 30-year loans when they can make more money making short-term loans and or invest in short-term financial instruments that they can buy in the markets. And so the lending dries up, and the earnings from the banks dry up. And the Fed's really worried about that. I mean, I think there's a good case to be made that inverted yield curves actually cause recessions than just being a sign of a recession. And so I don't know that we will get one, because the Fed is dead set against it, and they will shut the balance sheet until the long end comes up. I think that's kind of my guess. I've been wrong before, but that's my guess as to where this will go.
If they're unloading their balance sheet and they're continually raising rates, and we see this downturn in housing and everything else, where all of a sudden everything starts to implode, what does the Fed do then? Do they still raise rates, or do you think they're going to go in the opposite direction? Do you think they'll still continue to unwind?
So if we get the best case scenario, which is a gradual, on a nationwide basis, a gradual downturn with major implosions of real estate locally, but they cascade through. So, they maybe in one city in the first half of 2018, it may be in two other cities in the second half of 2018, and then it sort of stabilizes in those cities, and then it spreads around, so that it doesn't hit all at once. If that happens, I don't think the Fed will back off from its plans to shed assets off its balance sheet. It may modify its interest rate policies, but I think it's really set on trying to shed the balance sheet. If, on the other hand, the whole thing implodes all at once, they will throw the kitchen sink at it. They will do bigger and better things than they did before, and I'm sure of that. They have seen that if you print a few $1 trillion, you can paper over a lot of problems.
Do you think if we're taking the worst case scenario, if they throw everything like the kitchen sink, you're talking about more stimulus, what will this do to the economy? Will this actually help the economy, or is it just another gigantic Band-Aid that they're going to be putting on the entire economy?
Long term, I think it would be the worst possible outcome. The economy needs a cleansing. The economy needs to shed the debt it has, the excess debt. Now I'm talking about the global economy, not just the U.S. economy. U.S. economy too, but globally, really, that needs to happen globally. And so the best outcome would be a gradual process to shed those debts. The worst outcome would be a collapse with the Fed throwing in a few $1 trillion to maintain the high debt levels and increase them further. And so if that happened, if the Fed actually did do that, and we had that kind of collapse, we would end up in much worse shape than we're now. There'd be even more debt, and there'd be even more asset bubbles. There'd be even less work. This comes at an expense of the real economy, all these proceedings. That's part of the problem that we have right now. The real economy is suffocating, and and it needs some room to breathe. And the room to breathe comes from getting rid of its debts. And so if that process isn't allowed, I think it might stimulate the markets, but the overall economy will just be in worse shape afterwards than it is now.
Well, for my last question, do you see any black swans lurking behind the scenes that the Fed is very worried about?
Black swans aren't visible. And if you can see them, they're not black swans anymore. They're already here. So I see there are probably black swans out there that nobody is counting on right now. That's usually how they happen. What I see is a huge amount of risk in terms of asset bubbles all around. These assets have been used as collateral for debts. So we have this huge pile of debt. And that's not really a black swan because it's well known, it's well documented. Now we have charts on this and we have numbers, and we know it's not going to work out. We know there's not really a good way out of this. And so I think that is a huge risk, and it will come to haunt us. However, I do believe that there are some black swans lurking out there, and they will come. They will come out, and then we'll have all those problems that I mentioned, plus whatever the black swan triggers. And this may be a political event, or it may be a financial event. It may be a cascading failure in the insurance industry in China, for example. And we're kind of seeing signs of that. And so where the Chinese government can no longer really bail them out or deal with it, or refuses to, and what impacts this has on the world. And we're seeing Anbang getting in trouble. They're a big buyer of international properties, and the financial instruments all over the place. And these things could happen in a massive scale suddenly out of nowhere. And the insurance industry in China being in trouble, that's already kind of known. So that wouldn't be a black swan in that sense. But who knows? There's so many risks out there right now that any little thing could set off a terrific cascade of events.
Wolf, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work?
Wolfstreet.com, so like the animal wolf, and street like Wall Street.com. And I'm on it every day with several articles. I'm looking forward to seeing you all there.
And I'll put all the links at the bottom of this video, so everyone can just click on it, go right over to his site. Wolf, thank you very much for being on the Spotlight. I really appreciate it.
Thank you, Dave, for having me.
Thank you.